All right, everybody. Thank you for coming to the show. Thank you so much for joining me today. I hope you're doing wonderful on your Halloween. Happy Halloween to all you people. I hope you had some spectacular times out there, whether you were taking your kids out or whether you're a big kid yourself going out and enjoying the fun-filled festivities of the time. You know, what's interesting is that the entire point of Halloween is to celebrate, not really celebrate, but to recognize the fact that, you know, all things must die. And our ancient cultures used to celebrate this in a myriad of ways. And I think it's interesting how we've become so distant from the realities of life and the pain and suffering of life and, you know, what really makes life meaningful or worthwhile or living. And, you know, things have just become really shallow and meaningless and full of, I mean, for God's sakes, we celebrate Halloween, the grandest symbolic ritualization of the totality and eventuality of death for all mankind, and communion with your ancestors, your, you know, in that same oneness, you know, in that same sense, where you are celebrating or recognizing the reality of death and the eventuality of it to everybody. You are also realizing your connection in your ancestral lineage, that you are able to, you know, ancients believe that you could commune with your ancestors on Halloween. You know, it's the fall equinox when we see that night and day are equal and we're beginning to move towards the dominance of night. So what's interesting is that I think that that is juxtaposed on what we're seeing in the fiat currency markets right now. You know, I listened to Ray Dalio's wonderful 30-minute economic machine video, and it's really interesting, but I have an element of skepticism about it, because what he is describing sounds wonderful and fantastic, but it sounds like the shilling of somebody who wants to prop up the current financial system. And I've talked about this before, that gold had inherent monetary flaws, which naturally led to banking. Banking has natural inherent flaws, which leads to centralized banking, or a central bank, or the Fed. And the Fed is not evil. You know, I'm not really one of those conspiracy theorists that think that it's the Jews, you know, running the global financial system. I think I think that is the refuge of lunatics and fools who are willing to believe that. Those are people who just don't accept the complexity of reality. You look at how complex your own life is and think that you can not think that the global financial system is as complex. There's no simple answer to anything. All this stuff is extremely complex because you're dealing with human psychology and the interaction of people doing transactions. And in your own life, that's complicated and convoluted and nuanced. I think the key word here is nuanced. So we're seeing the night and day cycle of fiat currency kind of play out. And I think that the deleveraging cycle that we're going to be moving into is not going to be a beautiful deleveraging as Ray Dalio would like to say that it could be. And I think that's because we are so overridden with debt. I think that our central bank is going to resort to printing money faster in more quantity than income will rise. And I think that debt will continue to rise faster than income will grow. And that is what causes something like the Great Depression. So and just wax loquaciously about that a little bit, just kind of interested about it, just interesting, you know, to kind of contemplate, you know, what this all means and what we're doing in crypto, and crypto is not a savior. I don't really look at it that way. I look at it as one of the greatest inventions. You know, decentralized digital scarcity is one of the greatest inventions in mankind's history, and now we have that, and we can bring that forth to the world, and it's just exciting to be in this space and see all the wonderful innovation that's coming about, and that we actually just get to be a part of world-changing, massive consequential events, which is what cryptocurrency is, what Bitcoin is. So today we celebrate the 10-year anniversary of Satoshi Nakamoto's white paper. So, you know, I'm just going to go ahead and pull one in honor of Satoshi Nakamoto right now. You know, Satoshi, I don't know who you are. I know somebody knows who you are, but I just want to say, man, from the bottom of my heart, thank you. Your invention has changed the world. And although I'll never be able to express to you in person how dramatically Bitcoin has changed my life for the better, thank you, man. So excited to be here, guys. So with that said, let's get into it a little bit. Let's look at what we're talking about. Let's go to the charts. All right, man. So let's take a look at what we got here going on. All right, now I'm doing it a little differently because I got the chat stream on the side. So I'm gonna work this out, guys, and bear with me as I just kind of get the margins a little bit better. I want to make this as seeable as possible, and I know that that's hard to do on TradingView and hard to do in OBS, so bear with me. Thanks, folks. I appreciate it. So let's zoom this in a little bit. I want to make sure you guys can see this really good. So, okay, this might look really, really complicated, but I'm going to break it down and explain it to you. It's really, really not that complicated once I walk you through everything. You guys can go take a look at my TradingView post that I made earlier today. I made that this morning prior to the pump, and I called the price target within a few bucks. And not to stroke my own, ego or stroke my own beak here, but I'm just saying that these are the tools and the capabilities that you can see, these repeatable patterns over and over and over again. And that's when you act on a trade. The worst mistake that you can make as a trader is logging into Binance every day or going on to whatever exchange that you choose to use and looking for whatever is climbing up and just market buy into that. Now, don't get me wrong. There are good strategies for an asset that is appreciating fairly rapidly or that is trending upwards. There are very good trend trading strategies, but there are also, what you've got to learn as a trader if you want to be successful is that you can't do what everybody else is doing. You have to do what works for you, and what you have to train yourself to do is to look for repeatable patterns. Repeatable patterns that have a high probability, once you have recognized a certain pattern, a high probability of going the direction that you want it to go or that you're expecting it to go, with a fairly accurate price target ratio and a conservative risk, a conservative stop loss. So that's I think that's probably one of the biggest mistakes, is that people have extremely grandiose desires. I know traders that, and they're not good traders. A lot of people that are trading altcoins right now only want to take a trade if they can get like 20 or 30%. Or even worse, like 80 or 100%, and that's just foolhardy. Like, I will make 5 to 7% all day long, every day, and I'll throw $1,000 into each trade, and I can do this all day long. I can do this all day long, and when I lose, I'm only losing a small portion of my capital, and I don't use hard stops. I have mental stops that act as a target for me. But if price doesn't go my way, then I was wrong, and I cut my losses and I look for another entry point, because there's no point in saying this is another common mistake traders make. A trade will go against them and they'll be down 5%, and that's when they told themselves they were going to cut. But they look at the chart and they're like, oh no, I think it can turn around, so they double down. And then it goes down another 10%. And they're like, well, I can't cut it now. I'm down 15%. So then they buy more. And then the next thing you know, they're down 20, 30%. And they just blew out their trading account or lost all the profits for the last week or month or series of months. And it's ridiculous to take a loss. You're sitting there kicking yourself saying, man, I could have cut out of this yesterday with a loss of, like $50. And now I'm down 1,000. It's just, you learn these things. So talking about Bitcoin, repeatable patterns. So I'm going to talk to you guys about how to trade in consolidation and whether you can tell whether you're consolidating in an accumulation phase or a distribution phase. Accumulation phase is going to be a bullish form of consolidation in which you are expecting price to break to the upside, whereas distribution is bearish and you're looking for price to break to the downside. And there are multiple ways of doing this, but I'm going to show you how I do this. So the indicators that I have on the chart right now are simply volume, Ichimoku, which actually for these purposes I'm going to take off, VPVR, which for these purposes I'm going to take off, and pivots high-low, which I think is useful. And then around here I have the directional movement index. It's very simple. You just go up to your indicators. You can go to, it's right on the main thing, built-ins, and you just scroll down to the D's and it's directional movement. I've got it starred. And a few adjustments that I recommend setting is click into the DMI and you can press Alt-H, or otherwise you can go into your tools over here and click horizontal line. Alt-H is just a shortcut for horizontal line, so this is the tool that you want. And place one at 25 and place one at 50. And those are going to be really important reference settings that we're going to come back to. But I'm going to show you how you can tell whether something is accumulating based on volume and candlestick patterns. And I'm going to tell you how you can use the DMI to kind of shortcut that. So, and also you're not going to get 100% reliable indication all the time. When you do, that's the setup. That's a perfect setup. You know, if you have your textbook check marks of what you need a trade to look like before you enter in, or before you begin to look for an entry, you're gonna lean towards one indicator or one set of analysis more than the other. And I always lean toward volume and price action because that's what's actively going on in the market. Whereas an indicator can be thrown off by a rapid move in the market in the past that it is oscillating to catch up with, and you can modify that by changing your look back settings, and I'll actually show you an example of that. So we see here that I'm looking at the hourly chart for Bitcoin. We see there obviously that we broke down several days ago, and we worked all the way down here to $6,211. And that right there, if you're sitting in front of the chart, if you're sitting in front of the computer and you're seeing this price action, you're in a consolidation phase in a downtrend, at the end of a downtrend, and you see massive sell volume, big red candlesticks with huge long red tails pushing you down below support, that is generally a fantastic time to buy, and that is generally a fantastic time to aggressively market buy. And I'll explain to you why. Because first off, if you didn't have your limit order set, trying to place a limit order in a market moving on high volatility is quite foolish. However, if you use a market buy in this situation, it is the correct, appropriate way to use it, because we all know that the way that most people use market buys is they market buy when a price is rapidly moving upwards. And that is the wrong way to use a market buy. It has its place, but I'm going to explain to you why that is foolhardy. And the reason it is foolhardy is because, simply put, you are chasing liquidity the wrong way. So we all know that when you market buy into a price that is rapidly moving up, the price that is on your screen when you click that button, market buy, and you click confirm, is generally not going to be the price that you settle at when you go down and look at completed trades. When you look at completed trades, the price is going to be sometimes significantly higher. The reason why is because sellers were moving bids up so fast, or the order book was getting cleared out so quickly to the upside, that you were simply unable to catch. You were on the coattails of buyers moving up the order book. And so as a result of you chasing liquidity to the upside, trying to get in at the lowest price, because if price is moving up, obviously you always want to have bought in at the lowest possible price so that you can gain the maximum amount of profit. You're chasing liquidity the wrong way, and the rapid movement of buyers clearing out the sell order book is going to push your market buy price up. Hey, what's going on, Ben? Thanks for joining me, man. How you doing, brother? Glad to see you, man. Hope you're having a fantastic Halloween, dude. How are the kids, brother? So you're chasing liquidity the wrong way. And when you are looking to get into the optimum price and your market buy, conversely, sorry, let me flip that again real quick. So again, when you're market selling, say you bought in and price moves against you and then starts moving rapidly down, like we see right here, for example. Say you had bought in right here and you're expecting price to break to the upside, and then you see this and you attempt to market sell right around here. Most likely, you're not going to market sell until right around here, because this was moving on such high momentum and such high volatility that liquidity is pushing your price, your settlement price, down the order book. So that is not good for you, because you are going to end up getting out at a lower price. Hey man, I'm doing my best. I flipped the screen around a little bit here so that I could have the chat on the right. I hope that that makes the chart visible, that I hope it's not too crammed. So I'll have to see. I need to play around with this. I am going to be downloading Streamlabs for OBS, so hopefully I can just have it all nicely partitioned, and I won't have to worry about this anymore because this is just me on OBS. So hopefully I can get it a little bit more cuter, I guess is the word. So now that we understand that when you're using a market order to chase price in the wrong direction, because if you're trying to market buy, you're trying to get in at the lowest price, and market buy is not going to help you out in that fashion. It can't aggressively get you into the market, and there are times and places for a market buy and a breakout trade. However, that's not what we're talking about here. We're talking about trying to get in at the best possible price. So we see here that when you're market buying into high volatility, when a candle is moving to the downside, then you're chasing liquidity the right way, because just like your sell order is getting pushed down the order book, your buy order is getting pushed down the order book. So you're going to be able to get in at a better price. Because if you had been able to buy in here, anywhere in this low wick region, you would have been quite happy. And keep in mind, this is so important to understand, that at one point in time, when you were looking at this chart live, this was not a wick. This was a full-bodied red candle, all the way down to here, and then it started to turn around. This is when limit orders started getting filled, or bots and traders were aggressively market buying into this position. There's only one way to get that price, and that's to have a limit order set that you hope you get filled, but market buys are going to get filled before limit orders. So you need to be able to aggressively market buy in to a big red candlestick. Now that sounds counterintuitive, but once you understand this principle, you will become so much more successful in your trading, because these are the setups that I look to take. I look to buy in at the bottom. There's only one way to buy at the bottom, and that's if you buy on the red candlestick before it gets wicked up by buyers who saw what you wouldn't see or were braver than you were. That's the only way. It's the only way to get into the bottom. Now, that's not the only way to trade, but it's high risk, high reward trading. And actually, it's high reward, low risk trading, because you can always stop out if price continues to go against you with a fairly low loss ratio. 2R, 1R. You have to understand these things, but you see all the upside potential that we had here. Even, one of the greatest things about buying is this is a great scalping strategy. If you have a volume scanner like we do, and you see that price is down 10%, 15% on an asset in the last 5 minutes, last 30 minutes, whatever have you, especially the last 5 minutes, you aggressively market buy into that. 9 times out of 10, price shoots back up. Maybe it's just 1%, maybe it's 2%, maybe it's 3%, maybe it's more. You can just market sell out and take your profit. That's a way to scalp. But you have to have the cojones to aggressively market buy in to that rapidly moving bearish candle. So, consolidation. So we see here, when price is consolidating, it's trading around in a range, and it's not trending upwards, and it's not trending downwards, okay? And we need to know two things, maybe three, but two things. A, we need to know the range of the trading range. And in this case, we were ranging around from, and I didn't include these low tails, because I wanted to be as honest and realistic as possible, and I wanted to take the main candle body trading range. And because of that, the low range was right here at 62.34, and the height of this range was here at 62.89. And you can see here that after we wicked down to 62.11, we had a immediate retrace to the upside, which is extremely common, usually a 3.82 to a sometimes all the way, generally almost a 236 or 382 retracement of the entire movement. This one was a little bit more impressive. That looks like more like a point. That looks more like a 50% retracement. We retraced down here to the 618, maybe the 786 here, and then we kind of ranged around between the 786 and if I reverse this, the 236 and the 50% retracement. We had 1, 2, 3, 4, 5 touches, a brief peak down here, and shoot all the way down to 62.01, which was a stop loss hunt, and then we just shoot right up. So this is a natural end to an accumulation cycle. You will often see a stop loss hunt to clear out the order books, and for institutional investors, because right here, everybody that bought in this trading range, once they see a break below support, all their stops got triggered. And so you're having massive selling occur. And you have aggressive market buyers, just like here, step in to buy up this position. And this was the right place to buy in because the big money stepped in and bought this up, and price immediately moved up. Also, price moves up quickly because there are all the sellers have been exhausted, because everybody that bought in is selling here, and that's clearing out the order book of sell pressure and removing sell pressure from an asset moving up. Makes it much easier for price to move up very highly on high momentum, on high volatility. So how do we know whether something is bullish or bearish? Well, there's a couple ways. First off, you have to look at candlesticks, and you have to look at volume. So generally in consolidation, you want to see that volume is falling. You don't want to see rising volume in a consolidation period. That is not consolidation. And the easiest way to do this is with a volume moving average. And if you don't know how to do that, you simply click, sorry, the logo is in the way. So let me adjust here just a little bit. Move the logo out of the way. All right. So you simply go to the gear icon on volume, click it, and you can set your moving average length. You can set it to 0. You can go over to style and you can turn your moving average on or off right here. Or you can simply go here to the moving average length. 15 is the length that I like to use for my volume moving average. I quite like that. Length. Move my logo back. All right. So we can see here that if you just look at the moving average, that volume is falling. And if we just draw the line of best fit, kind of removing outliers, we can see that volume does fall just like that. Okay. So is there more bearish volume or is there more bullish volume? And in this situation, if you exclude this outlier, I would say that there is more bullish volume if you were to actually measure it. I would say that there's more bullish volume here. And you can also look at candlesticks. Which candlesticks are more impressive to the downside? Now, what I mean by that is how many long tails or wicks are there to the downside, and what candlestick formation do they form relative to how many wicks are to the upside, and what candlestick formation do they form? So here we see we have 1, 2, 3. So 3, and this is a hammer candle, a good reversal candle right here. And not a whole lot of momentum on these red candlesticks, with potentially this one, but this one has a nice long tail indicating that there's buyers at this range. And this one, which was the stop loss on, or the beginning of the stop loss on, excuse me. And so if we actually look at the momentum of the green candlesticks, we can see that the green candlesticks were able to travel much more ground in a much quicker time. And also, we don't see very bearish candlesticks. We don't see any evening star candlesticks at the top. This is just a spinning top doji. This is a shaved bullish candle with a small wick to the top. We have a lot of bearish, or excuse me, fully bullish candlestick formations here. Here. So not a lot of resistance to the bulls is what this is telling me. And a quick look at DMI will tell us all this. So when you see that when you've determined that that consolidation is either accumulation or distribution, either bullish or bearish. So just reverse everything I was talking about. If there's more selling volume than buying volume, and if there's more red candlesticks and more impressive red candlesticks than green candlesticks, that's generally an indication that you're in distribution. So then you need to measure your trading range. And again, I measured this range right here, and that is $54. And that's the measurement of these arrows right here. And then all you do is you take that measurement and you draw up from the point of the breakout, and that is most likely where your first impulse wave out of the breakout is going to reach, because you're going to be traveling on high momentum and high volatility on the initial breakout, and there should be little resistance to actually meeting that initial price target. So let's see here. So you see here that I had drawn 2 possible targets, and one was the 618 retracement, and then the second one was 63.42, which was actually the measurement that I measured upward. And you can see that we hit 63.36 and 63.42 earlier this morning on a dime within an hour. And for those of you who took that trade, that was not an official signal that I put out, but that was a target that I had been posting for probably the last 3 days. And it was a long that I had taken myself. I think I got in at 62.30. I think I was able to market buy right here as I saw price moving down below support. And again, talking about what I'm talking about, chasing liquidity downwards, chasing the order book in the right direction. So price broke to the upside, and now it seems that we are again consolidating. Now, what does DMI have to do with all this? Well, DMI can, in a glance, tell you whether price is consolidating, whether it's trending, and whether it's accumulating or distributing, and whether price is bullish or bearish. And the way it's measured is with 3 lines. We have the black line, which is the ADX, and what the ADX measures is the strength of the trend and whether or not price is consolidating or trending. And the way you can tell if price is consolidating or trending is when the ADX crosses above 25, price is entering into a trend phase. And when it crosses above 50, that trend is exhausted and you're looking for a likely reversal. So here we can see that on the hourly time frame, we did cross the ADX right here on this long bearish candlestick right here. And we trended up until we hit this range right here, at which case we realized that the upwards momentum from here to here was falling, because we can see that we did not, our volatility started decreasing significantly as we moved on compared to the volatility from 62.11 to 62.89. Volatility decreased, and so the ADX decreased until we went below 25, which lets us know that we're truly in consolidation here. However, we can see that we're in consolidation here because of the small trading range. So, and then it seems here that we are going to be breaking, and simply see rising. The green line is positive bullish momentum, and the red line indicates bearish momentum. So we can see here that bearish momentum is falling and positive momentum is rising until we actually get a crossover here, and then it crosses under, and then we get the breakout right here on the breakout candlestick, which lets us know. So this is actually a situation in which that DMI would not have been able to tell you that price was accumulating or distributing. But this is, I don't cherry pick examples, I'm just telling you how the indicator works. There are times and situations, many times in many situations, perhaps if we had a longer period of distribution, or perhaps if we look at this on a smaller time frame. Let's look at this at a smaller time frame. No, it seems like DMI would not have been the best indicator to trade this particular breakout. So this is why it behooves you to understand the basics of trading, which is volume, candlestick patterns, and general market psychology, which is when to buy and when to sell, and what market makers are likely to do in given scenarios and situations. So, but DMI is an extremely useful indicator that you can use to, at a glance, tell you generally whether price is accumulating or distributing, and that can let you know if you need to plan for a buy to the upside or short for a trade to the downside. So where is price likely to go from here? Well, for those of you familiar with Elliott wave theory, you know that generally after a breakout, price moves on 3 impulse waves up and 2 impulse waves down. So we'll get a let me get my paintbrush out here. So generally, when we get a breakout, we'll see a breakout like 1, 2, 3, 4, 5. Is generally what we're going to see following a breakout. So we can see we've had impulse wave 1 up to the 618 retracement, and now we're consolidating again. And here is an example of where you can use DMI. So we can see here that we are underneath 25, telling us that price is likely consolidating. And we see here that bullish momentum is much higher than bearish momentum. So this is, according to DMI, generally a place where you want to be looking to buy to the upside. So several ways to predict price. Obviously, we probably want to look at a higher time frame, and we want to look for areas of support that are now going to become areas of resistance. And so we see here that the 63.77 to 63.90 range right here seem to be fairly significant resistance, maybe even down to 63.60, although we already almost broke that. So I'm not looking for that really to be the next area of resistance. So I'm expecting somewhere around 63.80, 63.85 to potentially be the next significant area of resistance. Another potential way that we can look for price targets is to use a fib extension. So in this case, we could use a trend-based fib extension and we could measure this impulse wave and then current price, or wherever we think the bottom is. It's a target of 618 is the fib extension that we probably want to target, and that would be 63.98. So that falls right roughly into that range of support and resistance. So looking for a second impulse wave to move us upwards into the 63.90, potentially $6,400 range. So $6,400 is going to also represent psychological significance because of that $100 number, 6,400 as opposed to 63.98, 63.99. There's psychological resistance around those solid hard numbers. So yeah, and then we will see what we will see after that. Probably likely again a impulse wave move upwards, and then a retest either of resistance turn support here at 63.42. Or excuse me, 63, let's delete this, 63.53, or a 618 retracement of that level, which would likely be, if we moved from current price to the 618, would likely be around 63.36, so right around that same range. In fact, that corresponds perfectly with the 63.36 that was my initial price target. So impulse wave move up, lower retrace down, and then finally a fifth impulse wave, and then we'll just have to recalculate after that. It is entirely possible that we enter into a trending market after that. This could be the end of the bear market, although it's not exactly what I want to see. I wanted to see a really full-scale capitulation, really on the longer time frames, but I will take it on the shorter time frames, and I will trade it as I see fit and as I think the best way for you to trade is. Now, there is always a potential here that we drop back into the trading range, and that this really was not a true breakout, that it was a fake out. And you could almost say, with how many hours we just kind of slowly drifted downwards, that it could potentially be that. However, we are consolidating, and we are still statistically looking for a continued impulse movement upwards to the upside. So if things change, we will update you, and if they don't change, that's our analysis. All right, I'll keep the others quick. Looking at Ethereum. So looking at Ethereum, you can see here that looking at DMI, you can see that we are consolidating because we are underneath 25, and bullish DI is underneath bearish DI. However, we saw that that was not the best indicator looking at Bitcoin's trade. So are we looking for a break to the upside or the downside here? Well, let's take a look. We were consolidating from this initial move downwards, or excuse me, let's see what we're measuring here. Yeah, we're measuring the entire trading range. So from the bottom here to the top of this automatic rally, we are consolidating right now around that 618 retracement level, and we fell down. We definitely have some interested buyers down here at the 786 fib level at 186.95. So our trading range right now is fairly tight. I'm going to leave out the automatic rally right here, and I would just measure the trading range of true consolidation here, because that's going to give us more realistic price targets and expectations. So looking at a range of $207.84 to $190, so $17, maybe, roughly $17, almost exactly $17.04. So we are looking for a break to the upside above $207.84. If we break upwards, that would be $17 to the upside. So we're looking at coming back to the 236 Fibonacci retracement level here at 234.58. That would be a good target. And to the downside, looking to potentially retest, well, 190. So you're looking at 180, 173. So not as low as this support, but you're looking to basically stop loss hunt everybody that bought in here and here. So are we accumulating or are we distributing? Well, let's take a look. So 1, 2, 3, 4, 5, 6, 7 bullish candles. Sorry, let's extend that. My bad. Okay, so we're going to leave out this automatic retest, which is an example of the order book being cleared out here on strong sell volume, I think. And so we're going to leave out this wick, but we are going to include the second one. Is it arbitrary? Potentially, but it works for me. Pay attention. So we have 1, 2, 3, 4, 5, 6, 7, 8 bullish candlesticks, and 1, 2, 3, 4, 5, 6, 7, 8, 9 bearish candlesticks. So kind of tied. Let's look at volume. We see here that volume is falling. Good, we want to see that. Just looking at our moving average, we can see that volume is falling. And so starting here, we have volume here, volume here, volume here, volume here, volume over here. So we can clearly see that, you just take a look at this. There is more bearish volume here than there is bullish volume. There is more bearish volume. The bearish volume is taller, is stronger. We have some very weak bullish volume right here. But it's kind of equal, so this actually is a pretty neutral consolidation period, but it's going to break one way or the other. Now, I'm inclined to think that it's going to break to the upside, and I know that's a hard shot for me because I am notorious for hating Ethereum, but I really do think the price is most likely to break to the upside here, merely because, maybe because so many people want it to. I don't know if that's a very technical way to put it, but I just think that with everything else looking to break to the upside, I don't see why Ethereum should be left out in the cold. Oh, right, I know why. No, I won't say it. There's too many fans of Ethereum. I don't want to get hate mail. So let's look here and see what sentiment is doing. Yeah, sentiment is also neutral, guys. So this is Bitfinex shorts. This is Bitfinex longs. Longs slowly rising, shorts kind of falling off. So since we're not seeing a rapid move and we are in this kind of neutral period of consolidation, I am inclined to go with what the retail traders are actually doing in the situation, and they're going long. So we need to wait until we see a significant volume spike to move the market in one direction or another to break us out of this range, but I'm inclined to think we break to the upside. So if we do break to the upside, then there we go, that's about right. And sorry, holding my vape in one hand. So boom, and we'll take that same thing and we'll clone. And we'll move that right here. Try to get the best fit. All right. So, potential stop loss hunt down to 171, so $172, and a potential move to the upside of $227.50. So I'm inclined, this chart is neutral. The chart is neutral. I am inclined to think we break to the upside. But as it sits right now, there's not rising open interest on Ethereum, which means that buyers and sellers are not stepping in mass. Longs are slowly picking up, but that's equated by shorts falling off, and volume is fairly evenly distributed. So again, neutral chart, but I'm going to lean. I'm going to lean a little. Oh, I saw a message there. Sorry, in the YouTube, I missed it. Yeah. Got to play it smart. Can't let everybody know how I really feel about Ethereum. All right, so I'll finish off the show and we'll just take a quick look at Ripple. My love, my passion, my Ripple. Now, let's take a look here. So, again, we can see that DMI is underneath 25. We are clearly consolidating. And look at this like fine, beautiful dance between bearish and bullish momentum. I mean, it's just lovely, dude. I mean, it's just beautiful. Oh, geez. Let's go ahead. I'm going to disable TDMA for right now. But just, for those of you who don't believe in the validity of TA on higher time frames, you can see that the 9 would have given you a fairly good entry position right here. So we've got, let's turn our instantaneous trend off for right now and VPVR for the moment and just look at the basics. All right. So this was our weekly high low. And we see now that we have somewhat of a tighter trading range right here. So we bottomed out right here on fairly strong volume and had this automatic retest right here. So we're just going to take the current trading range into account here. And right now that current trading range is 47.47421. This is in US dollars. And 0.42760. So a really, really, really tight range here. Now, so let's take a look, guys. Take a look at this trading range, excluding this automatic rally. So we see that we have, and I'm going to exclude the screen candle. Oh, no, sorry. I'm not going to exclude the screen candlestick. I'm going to include that one. So we have one, 2, 3, 4, 5, 6, 7, 8 green candlesticks. 1, 2, 3, 4, 5, 6, 7, 8, 9 bearish candlesticks. And it does seem to me, however, that there is a little bit more bullish volume than bearish volume. It seems the bearish volume is a little bit lower. And just based off that, I'm kind of inclined to think that price would break to the upside. However, DMI at the moment says that bearish momentum is a little higher. But again, this fine, beautiful dance of DMI, bearish and bullish momentum. So it's fairly neutral, but it looks more bullish to me. So again, back to our regular job, guys. It really is this simple, man. This is how you trade a breakout. I mean, there's no, it's this simple. It's this simple and it works. Well, now I haven't talked about how to price yourself into a breakout. And I think I'll leave that for another time because this video is kind of getting long and I want to get out of here. So, looking for a break above 47. Let's see here. Let's click here again. Sorry. Looking for a break above 0.47263 to 0.52003. And again, I'm assuming that's not going to be a very high yield because of how tight range is. That's 10%. So that's a fairly nice little yield right there. And it's, again, what you do have to be cautious about is a stop loss hunt. You have to be able to differentiate the difference between a stop loss hunt and a break to the downside. And it's hard to tell in the moment, but you just have to take your, so there's a way to counteract it. And so I'll end this. I won't do a full talk about how to price yourself into a breakout, but I'll just talk about one way you can price yourself in and then a backup method in case you're wrong. So clearly if you're long biased and you're looking for a break to the upside, then you want to buy anywhere in the bottom 50 percentile of the trading range. So, anywhere. So you'd want to be looking to buy anywhere in this inside rectangle right here is where you would want to be putting your buys, potentially right now, although I would wait and see where price goes. And then you're looking for price to break to the upside, and then you simply set your stop below support. Now, what happens if you get a stop loss hunt and your stop gets hit? Well, you set a buy stop order for the breakout point so that you are buy stopping in a buy stop market order at point, and you can accomplish this with 3 commas or, depending on the platform that you're trading on. You can do this with BitMEX. So you set a buy stop right here with a price target right here, and you can set your stop loss somewhere right around here. Somewhere right around here, because if it's a fake out and price immediately moves against you, well, then you were wrong twice, but you've lost little. Rather than if you're right here, if you're able to buy in around here, well, then you're looking at almost 20% in profit. And you're only looking at losing potentially 3 to 4%. If you're wrong here, you have a buy stop set here, and price moves against you, you're only looking at losing a couple percentiles. Whereas you have upside of 10%. And that's extremely good risk to reward ratio. Now, again, as I was talking about earlier, like you can set your risk to reward lower so that you're not having so many false signals and stop outs. But we'll just keep it at that for the moment. All right, guys, I appreciate you so much for joining me today. Got to do the advertisements. Okay, so one thing I'm kind of excited about. Actually, you know what? I'll talk about this in tomorrow's video. So I want to flesh them out a little bit. That's you know, we've been in talks with some of our friends in crypto land here. So there is a potential that I will be able to start streaming for a new platform that has a larger audience range. So I appreciate everybody that's been watching and following me this far. You know, I just want to spread the technical analysis and teach people how to be better traders, and so that they can enjoy a comfortable lifestyle and learn how to class jump, which is one of the few opportunities. There are very few opportunities to class jump or really maximize your wealth if you are in the anywhere from the middle class down. There are very few opportunities for an individual like yourself to be able to take an investment and class jump. Those opportunities are available to you if you are in the upper middle class, and you're looking also at the financial deleveraging kind of global panic of 2019, 2020, and the rise of cryptocurrency as the dominant medium of currency in the world. So get on the train, guys, because the world is going to change in front of your eyes. And if you don't know how to handle yourselves in these markets, you're going to have a serious disadvantage when this becomes necessary for survival. And I would say that the best way to play is to act like it already is. So get your head on right, be in the game. All right, so hopefully that works out. If not, cool, I'll keep doing what I'm doing. If so, awesome. I'm really excited actually to work with them. They're good guys. So more information on that as it becomes available. CrackingCryptocurrency.com. I believe that we offer the best education, the best technical analysis, the best signals that you're going to be able to find out there in the market. And I think a huge difference is I am Justin Wise. This is me. I stand on who I am. I'm a public figure. You can find me on LinkedIn, blah, blah, blah. You can see my employment history. Been a trader for quite a while. You know, I'm not some nameless, faceless douchebag on some Telegram channel. You know, yes, I have a signals channel. Yes, we provide trading signals. Yes, this is my real name. Yes, you can find me, you know, I guess. Please don't. That's creepy. Just DM me, you know. If you want to talk on the phone, we can talk on the phone. Creeps. So, check out the Discord at discord.crackingcryptocurrency.com. We'd love to have you in there. All our socials are linked up in the thing below. Can't think of anything else I want to plug. Hope you guys have a wonderful evening. Happy 10th birthday for Satoshi Nakamoto's white paper. And I've been Justin Wise for CrackingCryptocurrency.com, guys. Keep it safe. Keep it cracking, guys.